Welcome back to the next episode of What's Your One More. I'm your host, Quinton Harris. You're dialed in for part 2 of this series with my co-host, Daniel Halvorsen. Welcome back here, Dan. Great to have you for the second episode.
Didn't even change shirts.
Never left, right? So, hey, listen, in the last episode, if you're tuning in, we did through a bunch of things. But, hey, this is where we're going to say we're going to break down dates. We're going to give you exact things of what we think is going to happen with the Federal Reserve. Why? We're going to back it up with data, with facts over fears. And, hey, listen, everybody's been making a forecast. You've had to shift the forecast over the last 2 years. But one thing has held true over the last 2 years. There's been consistent holding patterns and rising of rates. And we are at the point now where enough is enough, and we're about to start seeing some things turn the other way. And if you're in the mortgage business, this is great news for us. If you're in real estate, this is great news for us. If you're a potential buyer or you're a homeowner that's been locked in, hey, our times are coming. Looks like right before the election, maybe in the back half of the year, is going to be a fun time for our industry and a great time to take advantage of some opportunities that are going to present. So let's start with it here. Fed meets on the 30th. We're recording this on June 17th. All right, so what are we thinking here? July has went from a month ago to no chance in hell there's going to be a cut to now, hey, people are talking. People are talking about September, maybe even being a 50 basis point cut. Dan, I'll kick it off. Your thoughts?
I would say July, no. September, foregone conclusion.
At a quarter, right?
Yes, I think so.
Okay, so last time you were on the show, I had to go look this up. You said, hey, listen, Powell said a quarter does nothing to the market. Correct. It does nothing. That led me to believe it might already be built in, right? It does nothing.
Sure.
But then we saw a very stubborn Jerome Powell last week, had a meeting with the Senate Banking Committee, and then also spoke to an audience. And inside of that, we saw a very stubborn Jerome Powell turn into a little more dovish Jerome Powell. And he made some comments that made you think, oh, hey, wait a minute. July might be the date. Now, I know you're saying zero chance, right? It's not going to happen. But it's got a lot of people talking right now. And some of those comments were, I'm concerned about the labor market. And we've known for a while, to your credit, you said, listen, inflation, it's been coming down. It's winning the battle. It is what it is. We're going to get there in due time. But they're not going to get to 2% before they make this change. And that's what he said. But it's the labor market that's the big deal. And you've been talking about that for some time. And he said, yeah, it's got our attention. We are concerned with that. And I think at the levels they're at right now, is the train running away from the station on unemployment? Or have we seen it gone too far now? Is it going to the point where it could hurt us, that they have to do something? Is that what people are talking about right now?
Well, I mean, I think the Fed members are probably starting to understand that the jobs data and specifically some of the modeling, the seasonal adjustments, the birth-death model, I think they're probably starting to understand that there's some faulty data there, right?
Yep.
And if you're going to be data-driven, the data better be good. If that's what you're going to rely on.
Yep.
I mean, I think as far as if the train's left the station, two things I'd say to that. One, if you look at the current level of job creations, still positive.
Yep.
But the unemployment rate's still going up. So
that should not be happening. So
job creations can be at 150,000 and it not be enough jobs to support the economy and keeping unemployment low.
Right.
I think that's one thing to keep in mind. The other thing is, you're kind of in a delicate spot right now where, yes, the job market is still creating jobs and it's still, moving along, but it's also a very thin line where that could change very quickly.
Mm-hmm.
Right. And I think that's really, I'm not a Fed voting member. If I was a Fed voting member, I think that's probably what I'm looking at. Right. Because if we're at a kind of a delicate level right now and things could quickly shift the wrong direction, well, at that point, too late for a soft landing. So I think that if you're a Fed member, I mean, if you're looking at this and inflation was still 5-6% and it wasn't coming down, kind of stuck in a spot where you maybe have to create that job loss recession, but inflation is coming down and there's really no reason to think that it's not going to continue to slowly come down. Like, we're not going to go from 3% headline inflation back to 5%, right? We might go from 3 to 3.1, 3.2, but steadily moving down over the course of really the last couple years.
Right.
So if you're looking at that, you're thinking, okay, inflation's moving in the right direction. We probably need to go ahead and cut interest rates to make sure that we keep a very close eye on this labor market, see if we can try to thread the needle here and keep the labor market, productive. They don't, if the Fed wants jobs to be created, they want people to make more money. They just don't want them to make too much money.
Sure.
So yeah, I think that the challenge right now is the labor market is definitely very fragile. And you look at, even the most recent job report in June, you had 206,000 job creations on the headline, but April and May were revised down by just a few, 111,000 jobs. So you really had a net gain of 95,000 jobs after those revisions. And it's kind of, for the most part, it's the same story.
Yeah.
It's the same story every month.
Yep.
Job creations are great. Revision. Okay, it really wasn't that good after all.
Right. And the revision being, hey, listen, we're backing up and correcting it in a bad way.
That is correct.
Not in a good way.
Yes.
So I want the audience to know
the revisions can be up or down. They just happen to, for the most part, always be down.
13 of the last 14 have been downward revisions.
Correct.
Let's go back to that analogy. You come home from school and you're like, hey, Mom, I got an A on that test. 2 weeks later, you find out it was really a D. Right. That's a revision. That's a negative revision. And that's what we're getting to that extreme with the job reports.
Yeah, but the problem is that the markets look at it and say, okay, well, they got an A, right? They don't go back later and say, oh, this A was a D. We should change our stance. They say,
that's exactly what
it was an A when it happened.
Yeah, we took it then. We took it for credit then. And the reality is, at 13 out of 14, you kind of become numb. You almost expect it like, they're going to revise it. 13 and 14 becomes a habitual behavior in that market, which should not be happening. I want to make that real clear. That's not normal, but it's become normal, and that's a challenge. Hey, I got a screen up here. Charlie's going to put this in our, probably going to put it on the screen for us here as we're talking, but also on our YouTube channel at What's Your One More. So this is a graph, Daniel, and you've seen this a million times. Our friends at MBS Highway put this together, but this talks about the 19 Fed members. And of the 19 Fed members, not all are voting, right? But most of them are, right? And so inside of this, they talk about unemployment, and they said, hey, listen, we're concerned, and this was at the end of March, we're concerned if we get to anywhere between 3.8 and 4.1, 4.1 being on the high end. We get to that, we think we think we may have gone too far. What are we at today?
We're at 4.1.
Yeah, we're at 4.1.
Yep.
So I think I think this is the leading argument that you hear online about people going, hey, cuts are coming. I mean, it's almost as if like the markets are anticipating that cut in July now, as we've seen a little bit in the 10-year, but we've also really seen in the equity market. That equity market's roaring on the fact that they think this is coming, it's going to happen, combined with a couple other things that have happened in our nation. But I think that, they're saying, hey, listen, policy-wise, everything's falling in line. We feel good about it. It's kind of being built in. I think that's why you're also saying, hey, listen, a quarter's not going to do anything because it's already like they feel that already.
Yeah, I mean, for perspective, it took 20. It wasn't all 0.25% rate cuts, but it took 21 0.25% rate cuts to get to the current or rate hikes rather to get to the current federal funds rate.
That's how many it would have taken at a quarter.
Yes, and they did some 75s and some 50s, but for perspective, right? 21 quarter rate hikes, you go 1 quarter rate cut. You're not
ain't gonna do it.
You're not making a major move, and obviously you could argue the federal funds rate shouldn't be at zero, right? So I get that that logic is flawed, but that's kind of just to express how many hikes we had. One cut, and even Fed Chairman Powell has said a quarter percent cut in rates would be rather non-consequential.
Ain't going to get it done. Now, here's something that I want to make note of. So we're going to talk about two particular indexes here. The CPI, which is the Consumer Price Index. This affects consumers. But guys, for the record, admittedly, the Federal Reserve doesn't look at this number. They say they don't. I think they do, but they don't really give it a gauge, right? Then there's the PCE, the Personal Consumption Expenditure. That's what they look at. They look at both core numbers on this. We're currently in the core PCE at 2.6, is that right?
2.6, yeah.
2.6. So we're at 2.6. We already got a 2 handle on it, right? And then if you extrapolate the last 3 readings, because this is a 12-month moving average, if you just took the last 3 and you averaged that out, you'd be like 0.8. You'd be much lower than 2. So there's a high argument like, guys, we're already there. You're already curing it. You just got to let the other months run its course, right?
But if you just replaced the current shelter reading with or what is going into the PCE with what actual current shelter readings are, you'd be at 2.1.
You'd be there. So June was a favorable month. We got a lot of favorable readings in the economic data. We had a favorable CPI. We had a favorable PCE. There's some things coming in here. And then we just had another favorable reading here in the month of early July. This is leading up to this core PCE and the PCE headline that's coming out. There's a lot of belief because shelter was so low. Now it plays a heavier role in the CPI, but it was so low that we're going to see it at a lower emphasis in the point of the PCE. The PCE could come down. And if that comes down, a lot of people feel if job reports come in as expected, and we get another unemployment number at 4.1 or lower, or higher, that's what's leading to this. Hey, they're going to cut it in July. Now, I don't know the timing. I'll have to look up the economic calendar if they'll get the unemployment reading before they meet.
Won't.
They won't.
No.
Okay, so
30th is the Fed meeting.
Okay.
The following Friday they'll get the job data.
Okay, so it actually comes in later. So they won't know it. I mean, maybe they get a quick snapshot before everyone else. So they are the Fed, right? But the reality is, I think there's going to be some pressure there for a quarter cut in July, and it's coming from all different angles, more so than I think a lot of people thought prior to maybe the start of July, and then what happened on last Saturday night. I think there's a lot of pressure coming that way.
Yeah, no, I mean, I think that there's a lot of smoke around. Hey, it's time to cut rates.
It's time to turn the spigot back on. Right?
You're already too restrictive.
Yep.
Probably didn't need to hike the last 4 or 5 times you hiked rates. It's time to get the show on the road here. Cut rates. Inflation's moving in the right direction. Job market is slowing, right? Wage growth is slowing. Even if they cut by 50 basis points, it's not like when that happens, everybody's going to say, okay, now I need to go hire a bunch of employees now that the Fed funds rate is 0.5% lower.
Yeah, I always look at like housing, especially new builds, because it's important people understand the new build market. The new build market is what drives new inventory to our inventory depleted market. Like we need that new inventory. And so we gauge new inventory coming online. The consumer drives by a neighborhood and they see spec homes. They see homes that are going vertical. That's, in their eyes, that's new build, right? Over here, we look at permitting because permitting gives us a timeline of future builds down the road, right? And when you permit, you get more people working on the job site. And when you're having less permitting, that's less people working, all of a sudden that becomes unemployed because they're not building, the subs are not doing what they were doing before. Our permitting is significantly lower now than what it was 2 years ago.
Well, you also look at multifamily permits, very low.
I was going there next, yep.
Interest rates don't support a lot of these larger projects. So you start talking about we have a shortage of housing in comparison to household formations. Well, you're not going to single family home your way out of meeting that demand, right? You have 100%. To build multifamily housing, apartment buildings to house those people. If you don't do that, guess what? Rents go up. Guess what? Shelter costs go up. Guess what? Inflation goes up. Exactly. So you're also running the risk of, if you don't do something with cutting rates, that you're going to just have future inflation in the years to come.
Great point, Daniel. And I think what gets missed in this argument from the general consumer, and a lot of people miss this, another reason we're not in 2008 is because everyone learned from 2008. The builders learned from 2008. The financial advisors learned from 2008. The consumers that owned homes learned during 2008. And the one thing the builders took away was 2008, they just kept permitting and they kept building and they built all this supply, and we had way more supply than we did demand. The builders have learned and said, you know what? We're not comfortable with this 7%, 8% rate environment, because what are the builders having to do right now? They're having to buy the rate down. Well, when they buy the rate down, that takes away profitability. And the builders are not the Red Cross. They're not here. They're not the Red Cross. They are running a business. And so what they're doing is they're saying, hey, listen, we're just not going to build as much anymore. We're going to shrink the inventory way down until we get in a favorable rate environment that makes sense. And once we do, we'll start re-permitting. We'll start going vertical on the vacant lots that we have, and we will bring more inventory to the market. But till then, we're not going to do it.
Yeah, I mean, builders understand right now that with supply where it is, they have an opportunity to still make money. They just have to keep supply where it is.
Very limited.
They have to keep it constrained so they can continue to move product. They can advertise these low rates that, are below what the market is bearing, right?
Right.
And they're going to continue to do that until there's a reason for them to act differently.
Yeah, and the builders would much rather sell you a home at 5.875 with no points, that they're not paying any points, right? They're making, that's their profit,
right,
than sell you a 5.875 with them paying 3-4 points down to get that. They don't want to do that. But in the inventory that's vertical now, that's sitting, that's costing them juice, they want to get rid of that. So that's why you're seeing those favorable situations. But this is not a long-term solution for them. They want those rates lower. Correct. And that's how we get more inventory. Speaking of unemployment, I'm going to pull up my notes here because I took notes on this today. So one of the things that you've talked about is, hey, listen, the best way to kind of keep real-time data trends on unemployment is these initial claims and continuing claims, right? Yep. So they come out every Thursday. Matter of fact, they came out this morning as we're doing this podcast. So it came out at 243,000. That means 243,000 new people went to the unemployment line and filed for unemployment benefits.
Highest reading, I think, in about a year.
Highest reading in 11 months. 11 months, absolutely. So up 20,000. Continuing claims up 20,000. A current 1.86 million people, 1.867 million people filing continuing claims. Now, continuing claims are the people that are getting the benefit of unemployment for like the next 6 months. Or I think it's 6 months. They continue to get that claim, meaning they haven't found a job yet. meaning they have not picked up additional employment to get off of unemployment. That's the highest since 2021. That's the highest since we're talking about COVID numbers here on that.
Yep.
I think the Fed sees this as well. That's part of that runaway train we're talking about on unemployment, that it can take off on you. And, that doesn't include the people that have exhausted those benefits, right?
Right.
Because once you run out of those benefits, you're no longer in these continuing claim numbers, but you're still unemployed. This is interesting numbers. It's going to be something to keep up with and watch, because I think that, hey, listen, this is we're going to get another one of these before the Fed meets, is what I'm trying to say. We're going to get a couple more of these for the meeting, right?
In September.
No, we're going to get one more of these, and these come out every Thursday.
The claims.
Yeah, the claims. We'll get this Thursday. So we'll with these again. So we'll see exactly where that is, which kind of leads and kind of can give us a sneak peek of what the unemployment numbers look like kind of going in there. So I definitely think it's coming. So what else can happen to cause mortgage rates to come down? This is something we've talked about all the time. We're starting to see it happen. And man, what happened under the weekend has really added some additional pressure in a good way down to this disparity between these two metrics we're going to talk about.
Well, it spreads in between the 10-year and mortgage rates.
Right.
So, basically, generally speaking, the spread's, let's say 175 to 200 basis points, meaning if the 10-year Treasury is 4%, mortgage rates are somewhere between 5.75 and 6.
Yep.
Well, we spent a lot of the last 12 months at that spread being 300 basis points, meaning that mortgage rates were 3% higher than the 10-year.
For our audience, that has never happened on record before.
Yeah, that's just a sign of just mass uncertainty in the markets.
Right. Caused by banking collapse that happened.
Yeah.
The SVB, when you go to the SVB, you go to the date of SVB, we jump to that 300. Complete pandemonium in the banking market right
Yeah,
there.
and I think a lot of it was just not clear on the direction of what the Fed was going to do and where inflation was going. And, you're getting inflation coming down a little bit, not a lot. The job market was still very strong. So those spreads, they just continue to get greater and greater. And now, they're probably somewhere 240, 250 basis points, which is improvement, but you still have a lot more room for that to come down, which is why we keep saying if the Feds do cut interest rates, even if it's 0.25%, I think you could see mortgage rates be the beneficiary of that much more than what a 25 basis point rate cut would normally do, just because you're going to start to see the spreads get better. If the spreads were just normal, we would already be in the 5s on mortgage rates.
Right.
For reference.
And so we say and I kind of, if you're listening to this, you're going, wait a minute, you just said it might do more, but then you said it won't do anything. Let me explain to you what I mean by that. A 0.25 basis point is not going to drive down the yields of the 10-year Treasury to the point that a 50 basis point hike would do, right? Because the markets, what you're seeing right now, they've built it in. A quarter is a given. In the equities market, they've already built in that quarter, so you're not going to see this big rally, this bullish takeoff because that happened. You may get a little pop, but it's not going to be a bullish run. It's all priced into the market. Everyone is anticipating this quarter cut in July or September. And
prime evidence of that, interest rates came down considerably at the start of the year. The Fed said they were going to cut rates 3 times. Mm-hmm. Well, that got priced into the market. They actually, the market's actually priced 6 rate cuts in at that point. We like
a double approach.
So for evidence of that, when there's a thought process in the market, that information has already made its way into kind of where things are trading before rate cuts actually happen.
Right. And so, one of the things that I want to kind of give you an analogy, if you're listening to this and you're not looking at these charts on our YouTube channel at What's Your One More, and if you're not, please subscribe. I think you'll find a lot of this helpful as we're kind of showing this data we're providing. But think about this. If there's an ask and a bid price on a stock price, right? So let's imagine, and this kind of goes into inflation, quite honestly. But it's fear mongering. It's uncertainty in the market that's doing this. But if you went to go buy a stock, let's say Amazon, right? And the price of Amazon is traditionally X with a markup of just a tad for the ask bid price, right? Well, if that now was quadrupled on the ask bid price, but yet the valuation of Amazon is still the same on the equities market, you would probably consider, like, why am I paying that that more than higher normal price spread there to get this stock? And that's what's been going on in the mortgage market. And we're starting to see that spread kind of shrink down a little bit as more certainty comes back to the market. And so what could cause that certainty? Well, you've seen a stabilization in the financial markets, right? Not all the banks are going to collapse like everyone thought, like the secondary thought. You're seeing more stabilization and a very, very resilient mortgage market. and resilient real estate market. Prices have not collapsed. They've actually gone up. Mortgages are getting done. I saw where one of the larger banks was up 66% in the second quarter on retail origination. Like, there are people still buying homes. Things are still happening. So there's more faith in that mortgage-backed securities market, and therefore you're starting to see those come down. I think that you're going to see it come down even further. And to your point, if a quarter happens, you're going to see the spread evaporate quicker. And that's what I think Daniel and I are talking about as the big win would be mortgages there, because that 90 basis points he's referring to could turn more into, like, I don't know, 50, maybe 45. And then we still have room to go from there. But that's a huge windfall in that category, because if you took today's 10-year Treasury, I know we're getting technical with this conversation, but if you took today's 10-year Treasury, which I'm looking at right now is about 4.16, and you added the 150 basis points that Daniel just talked about, that would put you at 166. So you would round up to the nearest eighth. That's a 575 mortgage. Like, that's where we should be right now. And on all traditional argument settings.
575 to 6.
575 to 6. What would that do for the mortgage market?
Yeah, I mean,
I think it's a
you look at
rhetorical
June
question.
of last year, rates were low sixes, and the market really saw a pretty large uptick, especially where we are in Jacksonville. I mean, we saw a large pop in the market as rates kind of in the spring months came down. Some of that may have been they came down at the right time as we moved into a season where more transactions happened. But safe to say, a lot more activity. If interest rates came down to 6, you'd have a lot of people that would start to say, okay, I'm willing to sell this house I've got a lot of equity in and buy another one. I can make these numbers work, whereas I can't make them work at 7%.
So I get asked all the time, like, hey, Quinton, I hear you and Daniel talk, whether it's in person, on the podcast. It's like you guys live, eat, and breathe this, so you can have a general discussion like this, and you can bring it down to terms in which I understand. But, like, what are some quick hit takeaways we can give to some of the real estate agents listening to this, a consumer listening to this, or a mortgage peer listening to this? Like, what's some quick hits we could say, hey, listen, going into the next month, here's some things I would advise your customer, or here's some things I would take and look at to give you better kind of viewpoints of what's going to happen in the market. Because I think agents are always looking for a way to help explain to the buyer or explain to the seller why now might be the right time to sell or buy.
I mean, the first thing I would say is, the Feds meet in 2 weeks, a little less than 2 weeks now. I don't think they'll cut rates, but listen to what they say. I don't think they'll cut rates because I think that would be a surprise to the markets. And for whatever reason, the world we live in now, the Feds have to speak to the markets about what they're going to do before they do it.
Have to flash a signal.
So I don't think you'll get a rate cut, but I think that they will, in their language, all but say we're going to cut rates in September. So I think they're going to set up the market for that, right? So I think that's just evidence that interest rates are going to start to move in the right direction. So if you are a buyer that's been sitting on the sidelines, if we get a rate cut in September, that doesn't mean that, interest rates are going to go down 1%, right? But I think it's further indication. A lot of people in the real estate industry have been saying, hey, listen, if you purchase a home right now, it's probably a very good chance that you'll be able to refinance that home in the next year or two, right? And that timeline hasn't been as quick as we thought, but it's evidence that if you purchase a home, and the Feds are clearly in a rate cutting cycle, that there's a very strong likelihood that you would be refinancing that in the future. So the challenge is, they cut rates one time, are you then going to have this flux of buyers that say, I'm going to wait.
They're going to do it
because
again.
now rates are going down, right? And I think that the pivotal thing to keep in mind there is, well, if that starts to happen and rates start to come down, you're going to have a lot more buyers in the market. You're going to have a lot more difficulty getting an offer accepted. So if you're somebody that, is looking at a very specific area and a home comes up that meets your criteria, or maybe you need closing cost assistance, or maybe you need a 2-1 buy down, like your opportunity to negotiate those things is going to be significantly lower if interest rates start to come down, more of these buyers come in. So some of those things that maybe that you need for it to make sense may be off the table in 6 months.
Yeah, because we know the demand's there. We see the mortgage application index on the purchase side specifically. We know demand is there. To your point, you sit and wait, trying to time the bottom of the market. By the time you get there, the home that you wanted X is now going to be X plus plus. Yeah. Because there's going to be so many people fighting for that.
If you're a real estate agent, if you've got, I would presume you probably have some former customers that do want to buy a new home, that maybe want to sell their current home, that are on the sidelines waiting for something to happen with interest rates. Well, this is an opportunity to say, hey, let's go ahead and get things in order, right? Make sure your home is ready to list, engage with the lender, make sure that you are ready to buy, because if, we find ourselves in a rate cutting cycle, you still want to be in a position where you can act quickly and take advantage of that. Because if rates come down, if the labor market breaks, significantly less favorably and rates come down considerably, you're going to see prices go up very quickly, and you're going to see a lot of the same bidding wars, and, seller will not entertain a contingent offer. You're going to see a lot of those things happen again. So if you're somebody that's been on the sidelines waiting for a sign, like, this is probably, I think in the next couple of weeks, you're probably going to get your sign.
Yeah. And the first thing I thought you were going to lead with was, well, join my insider newsletter, right? Because it's great information and it's insider. You're getting it before other people do. And that link's going to be in our YouTube channel at What's Your One More with number 1. Daniel's Insider Insights is ridiculous. If you're not a part of that, sign up for that. And then I thought you were going to lead with that answer. So I'll go ahead and kind of plug you a little bit there, because I love that. I know that I'm signed up for it. Look forward to getting our producer's going to put that in the show. But here's something else. And I'm going to put my producer on the spot. He loves it when I do this. But back in November of 21, we had a discussion between you and Alex and myself. And inside that discussion on this November 21 episode, we talked about why the Federal Reserve has to raise rates and how they had to make it painful. I went back and listened to this episode, and we talked about why the pain has to get so bad that it takes time to make these rate cuts down to the consumer to where the consumer stops spending money. And I believe the exact analogy was, we had to say, they got to make it so painful you don't go to Starbucks, that you don't want to get that cup of coffee.
Right.
That they raise the price so much, you're like, nah, I don't need that. I can make coffee at home. That's where we are now. It took that long, November of 21 to where we are now. I mean, we're in 24, right? It took a long time for that theology to work its way through. But the reason I share that is not for our audience to go, I told you so. It's to show the timeline of how long that takes. And the recovery of this tightening that we're in, that restrictive territory, is not going to take as equally as long, but it will take time for this to come back to the level we need it to be at. So be patient with that. One rate cut's not going to get you where you want. And we may see multiple ones throughout the remaining of this year, but definitely into next year, right? We get past the election season, we're going to see that there. And I think to Daniel's point, that is where you're really going to start to see the wins, but start planning for the wins now. Don't wait until it's here, because then by that time you're gonna be fighting a much higher price point than you are now, and it's gonna look a lot different, right?
Yeah, and I mean, if you're trying to figure out, okay, if you do like to look at data and what's going on, my other advice would be, if you're looking at the job data, a lot of what you see on the CNBC, the Fox News, it'll just show you, here's the headline job creation, right?
Right.
But the other component of that is the household survey. So the headline number comes from the business survey. And there's a lot of modeling that goes into that. Mm-hmm. The household survey is, actually talking to people. Did I lose a job? Did I get a job? And when you're at an inflection point like we're at right now, the household survey oftentimes is a more reliable indication of what's going on, especially when you start looking at some of the modeling in these jobs reports and how you could see that there are some flaws in it and the downward revisions. Okay, well, if you look at the household survey and it's telling you that things are really not nearly as good, like, that may be more indicative of what's going on. And hopefully the feds are looking at that and not just looking at job creations and jobless claims.
Well, one thing you know about the Fed is they're data-driven. They're super proactive. So I'm sure that's exactly what they're doing, right, Dan?
Right.
Yeah, absolutely. By this time, hey, I think you've got the point. We think it's going to happen between July and September. Dan does not think it's going to happen in July, so he's going to make a bet with me now. If it happens in July, okay, you're going to wear an Ole Miss shirt to the next podcast. If it happens, if it doesn't, I'll wear a Florida one. How's that sound?
I was going to say, what, Vanderbilt? That doesn't.
Yeah, no, I'll wear Florida. I'll wear a Gator shirt in here, right? But I'm not going to do a Gator chomp. But I will wear the shirt. We're going to put a little skin in the game here, Dan, on our predictions here. So my bold predictions: quarter in July. Yours is no go. If 100% quarter in September. So we'll see how this goes here. But guys, if you like what you're hearing, please 5-star review this podcast. Share it. Hey, we love the feedback, the text messages and stuff you guys send post shows. Thank you so much. If you would throw those on YouTube for us at our YouTube channel, What's Your One More, leave those comments. We continue to answer all the ones you guys put on there, evaluate this stuff. Daniel, as always, dude, crushed it. Thank you so much for all the energy and effort you put into these updates and the research you do, man. I know our audience loves it. It's some of our higher viewed episodes, so thanks for being on the show, my friend.
Until next time.
Yeah, we'll see you guys in the next episode at What's Your One More. Thanks for tuning in.
I got one more shot, I'm gonna make it. One more chance, I'm gonna take it. I meant it when I said it, now it's time for me to do it. I got one life to live, so